Hi, this is Brian Yampolsky.
And I'm Joe Ashton.
And we are the co-owners of Orion Mortgage, and this is the Inside Track. And today's topic is about the new lower FHA loan limit and what that means to you. Joe's going to tell you a little bit about the history of what led to this. But most importantly, we're going to give you some really good alternatives that exist now. They didn't exist years ago.
Yeah. First off, we all know that the tightening of the credit markets has happened over the past 4 years, where Fannie Mae and Freddie Mac have gotten super tight on their credit underwriting. The offshoot of that was that FHA got more and more market share.
That's right, overexposed. They got too much of the market.
That's right, and that's not their government mandate. They're not supposed to be helping 80 to 85% of all the borrowers. And so over the past year and a half, they have done more things in order to shrink the market share that FHA has. The first thing they did was to increase the down payment of FHA borrowers from 3% to 3.5%. The next thing they did was to raise the mortgage insurance. They used to charge at a rate of 0.55% on a monthly basis, and now it went to 0.95 and then 1.15. And the final thing that they've done just most recently, which takes effect on October 1st, is that they've lowered the loan limit from $346,250 all the way down to $271,050.
What we want to do now is we want to show you the alternatives that you have to compare to what used to be the old FHA way and what the new FHA and new conventional ways look like. So let's say you're buying a house for $300,000. Well, first of all, if you're going to buy a house for $300,000 today, you won't be able to get an FHA loan because that maximum loan amount is now $271,050 for FHA. So the old FHA mortgage option would have resulted in $1,672 per month. That's no longer an option. So what we might look at now is a conventional loan with 3% down, and that results in a monthly payment of $1,773. Now, one big difference for that conventional loan is you're talking about 3% down instead of 3.5% down.
Right, and the mortgage insurance is high too on that particular product. However, it is an alternative to FHA as it goes away. There's a better alternative if your borrower can get back to the traditional 5% down conventional. Then the mortgage insurance is cheaper than FHA would have been, and the payment is about $100, $110 cheaper than what an FHA loan would have been. So that's 5% down with monthly mortgage insurance. However, really the best option is if you can do a single premium mortgage insurance. You pay it one time up front. There is no monthly mortgage insurance. You're still 5% down, and that payment is only $1,402.
So our point is that there are some really good conventional loan alternatives to consider today that compete with what used to be dominated by the FHA loans. The only way to really find out how that applies to you or your buyers or your friends that are buying is to have them call us at the number on the screen, or they can just shoot an email to us at the email address on the screen, and we'll be happy to talk to them about what they qualify for and give them these options so that they know what they're doing.
Yeah, there really is one big, huge, best option, and we want to show your borrowers how to get that lowest possible payment.
Thanks for checking in with us. We'll talk to you soon.
All right, bye-bye.